The global financial system is currently screaming a truth that almost nobody in the retail market is capable of hearing, because the average retail investor is completely addicted to short-term noise, flashing red headlines, and the absolute delusion that some central banker is going to save their portfolio from the physical laws of economics. If you are sitting there waiting for a specific interest rate announcement or trying to day trade the daily fluctuations of the commodity markets, you are actively participating in your own financial destruction, because true wealth accumulation is a game of absolute boredom, extreme structural discipline, and a complete refusal to entertain the emotional narrative shifts engineered by the mainstream media. Complexity is nothing more than a status signal for people who want to feel highly intelligent but remain functionally poor, and the moment you strip away the useless jargon from the academic elite, you realize that a flat, uninspired, bi-weekly discipline is the only path to real financial autonomy. If you cannot explain your entire macroeconomic investment thesis to a 12-year-old child in less than 2 sentences, you are not actually investing. You are just gambling with capital that you probably cannot afford to lose, while the institutional plumbing of the global economy quietly positions itself for a massive structural unwinding. Look at the raw reality of the European Central Bank and the broader central banking apparatus across the globe, because we are watching a movie that has played out time and more time again throughout economic history, where the bureaucratic elite prepare to aggressively raise benchmark policy rates in a desperate, knee-jerk reaction to rising oil prices. The mainstream narrative is completely obsessed with this idea of entrenched second-round inflation, completely failing to notice that the structural foundation of the global economy was already deeply fractured before this current energy shock even materialized on the radar. Even over in Europe, where the policymakers as an entire group tend to be far more aggressively hawkish and completely detached from the reality of the working class, several high-ranking officials have recently broken rank to express serious, deep, and rapidly growing concerns about the collapsing demand side of the physical economy. They are looking directly at the underlying labor market data, noticing that the apparent stability is nothing more than a lagging mirage, while the leading indicators for employment, total hours worked, and corporate hiring intentions are diving straight into a historical recessionary abyss. This growing internal panic fits perfectly with the reality that 2 of the most powerful, heavily tracked energy agencies on the planet just systematically gutted their global oil demand growth forecasts in a manner that we only witness during periods of extreme systemic crisis, like the year downturning Arsher or the year downturning Joe worldwide. The initial structural indications, especially when you analyze the absolute freeze in corporate hiring and the steady degradation of manufacturing payrolls, are already beginning to look identical to the classic historic energy shock case study. It is happening with such velocity that even the most stubborn central bankers are being forced to quietly reassess what the true catastrophic risk to the global economic engine actually is. Over the next 12 months, now, if you listen to their public speeches, they will still claim by and large that the primary enemy is consumer price inflation and that they must remain vigilant to anchor long-term inflation expectations. However, we are receiving an avalanche of data points on the other side of the ledger that completely exposes this narrative as a total lie. And these numbers were recently aided by the latest official forecasts from the United States Energy Information Administration. The administration just completely slashed its global energy demand growth estimate to basically absolute zero for the remainder of this calendar year, which is a structural warning sign that the retail market is completely ignoring. Its international counterpart, the International Energy Agency, went even further into the dark reality, stating explicitly that it now believes global energy demand will outright shrink and contract on an absolute basis this year. Let that sink into your mind for a single moment, because the last time global energy demand outright contracted was during the total economic shutdown of downturning Arsher, and before that it occurred during the absolute depths of the great financial crisis in the year downturning Joe. There is one critical, undeniable factor in this entire equation that the vast majority of commentators completely overlook, or just casually dismiss as a temporary anomaly, and that includes the central bankers themselves, and certainly the participants driving the speculative stock market bubble. That factor is the incredibly weak, depleted state of the baseline global economy before this current energy shock even began to take hold of the distribution networks. While the talking heads on television spend every single waking hour debating the potential for sticky inflation and the exact path of interest rate hikes from central bankers, we are tracking a mountain of hard data across Europe and the global oil markets that proves we are moving directly into a synchronized global recession. Go back and look at the physical reality of Europe over the past 24 months, because it was not long ago that the entire European manufacturing sector was trapped deep within a brutal, structural recessionary territory that rivaled the worst periods of the European debt crisis. particularly over in Germany, which has historically functioned as the absolute industrial heart and economic locomotive of the continent. The data was an absolute horror show where every single consecutive month brought worse production numbers, lower corporate margins, and deeper industrial decay. Major industrial corporations were quietly laying off non-essential staff, cutting structural capital expenditures, and preparing for a prolonged period of domestic stagnation, until the government stepped in with massive public announcements regarding defensive military spending. The financial media immediately got incredibly excited, screaming from the rooftops that a factory renaissance was underway, that public spending would save the day, and that everything was going to be completely fine for the broader markets. Then the energy shock hit the system, and what you actually saw was a temporary artificial front-running of demand where companies rushed to purchase inputs before prices exploded, creating a massive illusion of economic growth and optimism. We saw the exact same fraudulent signal occur right here in the United States, where everyone started bragging about a structural manufacturing boom, while completely ignoring the underlying rot within the actual domestic labor market. When you look beneath the surface of these optimistic corporate surveys, you do not see a single shred of actual sustained net hiring, because what you are witnessing is merely a temporary pickup in total hours, worked as factories scramble to fulfill old backlogs before the consumer completely dies. The factories are expressing a superficial sense of optimism to the media, but their actual behavior proves they are terrified of the future because they are completely refusing to expand their permanent workforce or commit to long-term labor contracts. This is the exact structural trap that Europe is facing at this very moment. Because corporate boards have already laid off so many structural workers over the past 2 years that they know local consumer demand is about to completely fall off a cliff. When we talk about inflation, the average retail investor assumes all inflation is structurally identical, which is why they get completely wiped out when the macro cycle turns against their portfolio. You have to understand the fundamental difference between demand LED inflation, where a robust economy with rising real wages drives prices higher, and supply-side energy inflation, which is nothing more than a regressive tax on human existence. Supply-side energy shocks do not create economic growth. They simply squeeze corporate profit margins, force manufacturing plants to reduce operational capacity, and compel the average household to aggressively pull back on discretionary spending. This exact macroeconomic script has replayed time and more time again throughout modern history, and we know with absolute mathematical certainty where this road ends for corporate earnings and employment. Companies will initially attempt to absorb the higher input costs, but as consumer demand continues to evaporate, they will have no choice but to aggressively cut temporary hours, freeze hiring, and eventually transition into mass structural layoffs. The seeds of this economic destruction are already deeply sown across the Eurozone. And how any honest analyst can look at this data and believe Europe will emerge remotely unscathed is completely beyond my comprehension. It is glaringly obvious that the European economy is headed directly into a severe, prolonged recessionary contraction, and the tragic comedy of the situation is that the European Central Bank is going to do exactly what it always does during a major policy error. They are going to aggressively raise benchmark interest rates right into the teeth of an impending economic collapse, completely repeating the exact disastrous policy blunders they executed so perfectly. Back in the year downturning bot and twice back in the year downturning Ishii. It seems to be an absolute prerequisite or a special talent that you must demonstrate to the political elite to secure a top job at the European Central Bank, because their capacity to raise interest rates directly into a structural recession is unmatched in the history of central banking. The only indicator that ever truly catches the attention of these academic bureaucrats and convinces them that their underlying models are completely broken is when the official unemployment rate starts to aggressively spike in the hard data. When unemployment begins to rise across the major sovereign economies, even before the full downstream effects of higher energy costs are realized, the entire baseline narrative of a soft landing completely disintegrates into thin air. The economy was supposedly turning around in a massive structural recovery during the late months of Arding and moving into the early weeks of Arding. Yet the actual gross domestic product numbers and sovereign employment reports tell a completely different story. Look at France, which represents a massive pillar of the Eurozone economy, because they have been printing negative net payroll numbers for 2 consecutive years, pushing their domestic unemployment rate to a staggering 8%. Even when you aggregate the data across the entire euro area, total employment growth has slowed down to basically absolute zero, printing a year-over-year change of just 0.5%, which is historically deep within the boundaries of a full-blown recessionary cycle. if you are an honest official sitting inside the central banking apparatus. You are looking at a labor market that was already fundamentally weak and getting weaker before the energy shock even had a chance to propagate through the consumer supply chain. Historically, the terms energy shock and economic recession belong in the exact same sentence because they are structurally linked by the laws of thermodynamics and consumer behavior. Yet the market continues to price assets as if this time is somehow different. Now, all of a sudden, the European Central Bank is starting to publicly alter its tone, realizing that the hard data and deteriorating consumer sentiment are confirming that the historic energy shock recession case is already playing out across the continent. Before we dive deeper into the inverted interest rate futures markets and the collapsing consumer credit data across the globe, I want to take a quick moment to talk about the sponsor of today's video, monetary metals, because they are solving a massive structural problem that I have been yelling about for years. The vast majority of people view precious metals as a purely defensive, passive, safe haven asset, which means you purchase physical gold, lock it away inside a secure vault, pay a recurring storage fee, and watch it sit there doing absolutely nothing for your cash flow. Monetary metals completely shifts this legacy paradigm by allowing individual investors to earn a real, tangible yield that is paid directly in physical ounces of gold, without ever forcing you to give up your underlying ownership of the asset. This is not some speculative paper fund. It is not a complex digital claim token. It is your actual physical gold being productively deployed to earn a consistent return that is deposited directly into your account every single month. The entire process is simple, transparent, and fully insured, which changes the entire game for individuals who believe in precious metals as the ultimate long-term store of generational value. If you want to stop paying holding fees and start compounding your hard assets, go to monetary-metals.com/NDR to review all the structural details and see how you can make your wealth work for you. We truly thank them for partnering with the channel, and now we are going to get right back into the absolute rot that is currently eating away at the global financial system. The reality of the central banking playbook is that the individual actors inside these institutions desperately wanted to raise interest rates over the past few years. Not because the economy was structurally robust, but because they knew deep down that the system was incredibly fragile. They needed to aggressively manufacture some form of interest rate altitude, so that when the inevitable economic collapse finally arrived, they would have a superficial excuse to slash rates back down and claim they were magically saving the economy with monetary stimulus. The catastrophic problem they face right now is that their interest rates are still relatively low on a historical basis, meaning that even if they execute a rapid path back down to absolute zero, the actual stimulative impact on the physical economy will be exactly zero. Central bankers all around the world sound incredibly nervous during their public appearances because they know their institutional credibility is on the verge of being completely and permanently destroyed in the eyes of the general public. You can look directly at the institutional bond markets, the deeply inverted yield curves, and the forward interest rate markets like the Euribor futures, which function as the euro-denominated twin to the secured overnight financing rate, futures that handle trillions of dollars in global liquidity. When you analyze the physical shape of the interest rate futures curves right now, you notice a distinct, undeniable frown that represents the explicit market expectation for near-term policy error, followed by total economic capitulation. The market is pricing a high probability that central banks will attempt to push short-term rates higher over the next few weeks to combat the superficial appearance of inflation, but will eventually be forced to pivot violently and slash rates as the underlying economy breaks. This exact inversion was heavily visible in the futures markets well before the geopolitical conflicts in the Middle East even entered the equation, proving that the structural weakness was already fully priced by the smartest liquidity participants on Earth. The market was already pricing aggressive, unprompted interest rate cuts from the European Central Bank, starting from a baseline of just 2%, because participants understood that the global economy did not possess the structural altitude to handle even moderately tight monetary policy. Now you inject a massive supply-driven energy shock into this highly leveraged, structurally weak foundation, and the cost of basic human survival through food and energy is exploding across every single major consumer market. The global consumer cannot absorb these costs indefinitely because real average hourly earnings have officially turned negative due to inflation for the first time in 4 years, forcing the average household to completely liquidate their remaining pandemic savings. When you look at the latest retail sales data, the absolute disaster is staring you right in the face. because nearly every single dollar of consumer expenditure is being completely swallowed by the non-discretionary categories of food and fuel, as the average worker is forced to allocate their entire paycheck to keeping the lights on and putting food on the table. Their discretionary spending across the broader retail economy completely evaporates into absolute nothingness. As this massive demand destruction backflows through the corporate supply chain, manufacturing orders get canceled, business revenues collapse, corporate profit margins compress to zero, and the labor market shifts rapidly from a hiring freeze into an outright slaughter. The frown in the futures curve is telling you that while central bankers are stupid enough to raise rates in the short run to chase a temporary oil spike, the fundamental laws of economic growth and inflation are turning down so hard that the authorities will spend the next 2 years playing an aggressive game of catch-up.